Have you ever wondered how some people get bigger returns than others? What is the difference between someone who might see 4% return, 6% return, 10% return? How do some people get 20% returns or even more? Well, in today's episode of The Difference, I'm really going to dive into how I personally have gotten 20% returns all the way up to 60% returns. And I think this is an episode that's absolutely going to change the game for you. Come on in and enjoy the conversation. What's up, everybody? Jamil, Frazier, founder of Think Life is Different. On today's episode, I'm really going to be diving into the two ways that I invest that historically have gotten me bigger returns. Now, remember, all of these things I can only tell you from my own experience. I'm not telling you that you should go do this, and I'm not even saying to do it like I do it. I'm just going to break down for you how all of my brokerage accounts are higher than 20% returns. And it's because of the way that I invest. I just had something happen to me the other day. You know, as you guys know, I do a 1 day to wealth webinar pretty much every week, every other week. And I had one of our students jump on our webinar, and, you know, on my web classes, I really do show a lot of my own personal investments. Yes, I talk about, you know, stories of our students and people that are having great success. But one thing that I realized just from being in this world of social media, and this is all new for me, as you guys know, you know, I've spent the last 10 plus years trying to be, trying to hide, just trying to work my own business and really create leaders that can go out there in the marketplace. But I really didn't want a ton of people to know about me. I wanted to have some sort of anonymity. Is that I basically wanted, I didn't want to be out there in the public, but I wanted to help people build businesses so that they could be out there in the public. So as I've gotten in this whole kind of like social media space, it's been new for me. And and what I realized from watching other content creators and listening to a lot of people in the coaching, consulting, service provider space is that a lot of people talk about things that they have no idea about or that they have not demonstrated to do themselves. So I am very transparent oftentimes on my different webinars and events, because I think it's important for you to know and the audience to know and the listeners to know that this is what I do. And not only is it this is something that I do, it's something that I've been doing and that I've done. And so one of the students, as I was kind of breaking down the growth in some of my accounts, she asked a question that I never have really even considered. It's just because it's something that I've been doing for quite some time. But she said, you know, how are your accounts sort of outpacing the market? How are your kids' accounts outpacing the markets? Now, I'm not a stockbroker, right? I'm not a financial planner, so I'm not telling you to do these things. I'm just sharing with you what I have been doing for the last, 7, 8, 9 years, and why my accounts consistently see a little bit more in return. And it's really because of the two ways that I invest into the stock market. Now, I'm not saying it's right. And again, I'm not telling you to do it. I'm just telling you what I have been doing. So a lot of you guys know from either reading my book, The Richest Man in Direct Sales, or maybe even studied my newest book, The Freedman and the Oak Tree. But I have a very simple rule when it comes to money. And you guys know that I graduated high school with a 2.2 GPA. And so I wouldn't say that I'm the brightest dude. And so I needed a framework to really help me, a very simple individual, on how to start doing different things with my money. I just needed structure, right? Just like if I had a nutrition plan and I need structure in that nutrition plan, I needed structure when it came to how to manage my money so that I can start having more of this money actually start working for me. And so when I started on this journey, I wasn't making very much money, only $3,000 a month, right? I quit my six-figure medical sales job and I had literally just started building a business, which before I decided to go full time at building this business, it was just a part-time gig. And part-time, I was only making about $2,500 a month. And so that was a big setback for me when I was making about $8,000 a month. And so now I'm starting to build this little business. And now when I decide, hey, I'm not about this life. Like, I hate struggling. I hate feeling anxiety. I hate feeling like I'm back on welfare. I hate feeling like I don't know what to do. And when I had that moment, that shift, I was only making about $3,500, $4,000 a month when somebody gave me this framework, which is the 70-10-10-10 rule, or sort of framework for what I started doing with my money, which is basically 70% of that $4,000 I lived off of, and I had to get my living conditions down to fit in that 70%. 10% I would put away into savings, another 10% I would put away into investing, another 10% I started giving away, tithing to charity, and to start to fund different foundations that we felt like as a family were really important to us. Well, you guys, that doesn't leave a ton of money for investing. That's only $400 a month, right? And so I needed to figure out a way, how do I start scaling this income so that I can start making more? And my strategy was to just simply build the skill sets that it took to build my business. Now, as my income's going up, it's giving me more money to start investing. And that's what I want to talk about today. What are the two ways that I started investing and even invest today to where we see higher returns? Well, the first way was to do what we call dollar cost averaging. And what does that mean? You remember when I told you that 10% of my income, I'm investing that somewhere. And what that means is if I'm making $4,000 a month, then $400 has to consistently being invested somewhere. Let's just say that that's being invested into a brokerage account. And let's just say that that's being invested into a standard ETF that really tracks the S&P 500. What does that mean? It means that every single month I'm investing $400 into the top 500 companies in the United States. Now, I'm not doing it all an individual into these 500 companies. I'm just finding a little ETF or mutual fund basket that is going to have all of these 500 companies in this one stock itself. And so now my $400 every single month on auto pay, on automation, is just going into this basket of stocks every single month. January, it's going in. February, it's going in. March, April, May, 2013, 2014, 2015, 2016. It is just happening every single month. You set it and you forget it. When your income goes up, now to $5,000 a month, you change it. Instead of only $400 going into this investment, now it's $500. When your income goes up to $10,000 a month, now we change it. Instead of $500 going in, $1,000 is going in. When your income goes up to $20,000 a month, you change it. Instead of only $1,000 going in, $2,000 is going in. Now, when your income goes up to $100,000 a month, you change it. Now, $10,000 a month is going into this thing. This is what we call dollar cost averaging. Now, here's the crazy thing. Over time, that investment, that stock, isn't just going to keep going up. It's going to go up, it's going to go down, it's going to go up, it's going to go down, it's going to flatline, it's going to take a really big dip, and it's going to go up by a lot, and it's going to keep doing this all the time that your money is going in. Now, here's the crazy part. When it goes up and you invest in it, you're going to be investing when it's actually kind of high, right? But then it's going to dip down and it's going to dip low, and you're going to invest now when it's low. Now, here's the great thing. You make most of your money when that stock actually falls. I know it sounds crazy, right? Because we think, oh, if it goes up, that's the best part. It is not. The best part is when a good company drops and you get to buy it on the dip when it's on sale. And it's what I tell my kids. Like I just simply ask them, I say, what is your favorite thing when we go to Trader Joe's across the street? What's your favorite thing to get? And they'll say, you know what, Daddy, like I love to get a popsicle. And I would say, okay, how much does a popsicle cost? And they say it costs $5. I say, great. I say, what if that popsicle dropped down to just $1? What would you do? And they say, I'm going to buy more. And I say, well, why would you buy more? And they say, because it's on sale. It's the same thing that happens with investments. I don't care if it's a stock. I don't care if it's real estate. I don't care if it's a business. When it falls, and if it's a good company, eventually it's going to go back up. So you want to buy when it dips. Okay, remember that for when I tell you about the second strategy. So when you're doing dollar cost averaging, you're just investing every month. You're not worried about if the stock goes up or down. You are just investing every single month. Now, when it goes up, you're going to buy some. When it goes down, you're going to buy some. And eventually it is going to average out, and it's probably going to be somewhere around maybe 8%, 9%, 10%, 11%, maybe even 12% that you're going to get in returns over time. Sometimes your percentage is going to be a lot lower because the market is down. Sometimes the percentage is going to be a lot higher because the market is up. But over time, you're probably going to be somewhere around 8 to 10% returns. It's kind of dope, right? It's kind of dope. Like if I can get 8, 9, 10%, 12% return on my money, then what this means is every 7 years, whatever you invested is going to double. Okay, so let's just say I invested $10,000 right now in 2025, and I get a 10% return. That $10,000 is going to double to $2,000 7 years from now, which is going to be about 2032. And then in 2039, that is going to double again. So it's going to go from 20,000 to about 40,000. How dope is that, right? And that's how the compounding works. So how have I been able to get higher returns than that? It is because of I not only do dollar cost averaging to where a certain amount of our income just keeps getting invested. I don't even think about it anymore. It just automatically gets taken out of my account and my wife's account, and it just gets invested in different places, right? Every single month. Now, this is good because you don't want to necessarily time the market. You want to spend time in the market. Let me just say that again. Where people get in big trouble is they try to time the market. Timing the market is just waiting for it to drop and then investing, trying to time when it drops so you can invest when it's low. Most people are not bright enough to do that, and so they end up losing their money. This is why you just want to do dollar cost investing so you can keep investing every single month and you don't have to worry about it because you're spending time in the market and compounding interest is growing. Now, the second thing that I do is I actually do time the market. Well, Jamil, you just told me not to do that. I know, but let me give you a little bit of background. I don't just time the market. I do both. So I spend dollar cost investing to where every month 10% of my income is getting invested. But I also start piling up a big pile of cash, as big as I can, right? Like you might be able to stock up a pile of cash that's even bigger than mine, right? And I might be able to stock up a pile of cash that's bigger than somebody else's. It doesn't matter how big the pile of cash is. It could be $100. It could be $200. It could be $2,000. It could be $10,000. I don't know. All I know is I start piling up a good chunk of cash. And what I do is I wait. Wait for what? I wait for crazy times to happen in the stock market, in the real estate market, and in businesses because I am going to time the market. And when the market falls, like it just did in April of this year, 2025, oh, my mouth starts salivating. I get so excited. Why? Because it's time to go in. And I don't care if it's stocks. I don't care if it's real estate. I don't care if it's businesses. It could be oil. It could be gold. It doesn't matter to me. What matters to me is that the market falls. Why? Because just like that popsicle went on sale, this freaking stock market just went on sale, or this real estate market just went on sale, and it is time to buy more. It's exactly what my kids say about these popsicles. It's the same thing I look at when I'm looking at stocks or real estate or whatever. So in April of this year, as you guys know, in late March, President Trump had started, there was rumbles about he was going to really lay out his plans for tariffs, taxing other countries for goods and services. Well, when I pretty much knew this was going to happen because this is what part of the ticket that he ran on. And I also know that when there's any type of fluctuations in the market, or things start to happen that don't normally happen, or when things look scary, I know that when things are scary or appear to be scary, then people run. And when it comes to investing in the stocks or real estate, when things get scary, when people run, they sell. Now, when they sell, that makes things a lot cheaper for guys like me who are sitting on the sideline and that have been preparing for this with a pile of cash. And remember, when I say pile of cash, whatever that pile is for you, it could be $100, right? It could be $1,000. It doesn't matter. But I have been waiting and planning for this crash. And sure enough, President Trump has a meeting, and he lays out his plan for his tariffs. And he says, Canada, we're going to tax you this much, Mexico this much, China this much, European countries this much. And when that happened, of course, people get nervous. They say, well, we're invested in Amazon, and if Amazon, it's going to be harder for them to get goods and services, then we're afraid that that company isn't going to be as profitable, and I don't want to lose my money, so they start pulling out their money. And so what happens is, let's just say Amazon is trading at $100 a share. Now that goes down to 50. And obviously, Tesla has been under a lot of controversy with Elon Musk. And so what's going to happen to Tesla's cars overseas in Europe and in China and like all these other places? It's going to be harder to get these vehicles sold. And so we get scared. And so we sell off our Tesla, and Tesla might be trading at $350 a share, but now it falls to $200 a share. You see how these things start to go on sale? And so what I do is I just sit back and I watch, and I have part of my investing strategies is just dollar cost averaging. It's just investing every month. And what I'm doing is I'm paying attention and I'm watching for this market to fall, to fall, to fall, to fall, to fall. And when it gets here, I take that big pile and I invest. And so now we're sitting here in August 2025. And even though just a few short months ago, everybody was afraid. The stock market was at its lowest that it had been since 2022. And now just a few months later is the highest it has ever been in the history of the world. And so now when I just took this pile of cash, let's just say it was $1,000, and I invested it at its lowest, now that it's back up at its highest, it didn't just grow by 10%, it may have grown by 50%. And so now when you average out the dollar cost average investing, which might give me a 10% return, plus my 50% return because I did time the market, now I might have a portfolio that's at 30%. And that's exactly what I've been doing since 2018. I spend time in the market and I also time the market. I am waiting, literally waiting for the market to crash. Now, I know that might sound crazy, but this is what investors do. We wait for things to go on sale so that we can buy it. So because we know that nothing is static. Everything has ebbs and flows in life. Things go up, things go down. In your relationship with your husband or your wife, it's never just static. Sometimes it's up, sometimes it's down. With your weight, it's never just static. Sometimes it's up, sometimes it's down. Your love for your kids, it's never just static. Sometimes it's up, sometimes it's down. This is how life works. Now, in investing, where you see your biggest returns, it's when it's down and then when it comes back up. And so these are the two strategies that I employ that have gotten my accounts to be above 20%. I have accounts that are above 60%, and it's because I utilize these two strategies. I do dollar cost averaging investing, where the same amount just gets invested every single month, and then I also time the market. I also keep cash on the side so that when the market falls, I can go in and I try to buy up as much as humanly possible. Even if I don't have the money, I go find the money because I am looking. I know that it's a deal and I know that's an opportunity, and I know that this opportunity, I may not see it for another year, 2 years, 3 years, right? Like the last big opportunity like this was in 2022 and it's 2025. I had to wait almost 3 years to now take this cash and like go this big in the stock market. And so next is probably going to be the real estate market. I don't know, but when it does happen, I will be ready. So hopefully that gives you some insight on how my accounts give me larger than a 20% return. It's not because I'm smart. It's not because I'm bright. It is because I've learned to just pay attention. Now, again, I'm not telling you to do this. I'm just sharing with you what I do. If this brought you any value at all, I want to encourage you to share it with somebody who you love or who might want to maybe start employing some of these strategies. Go on and like this video and make sure to subscribe to the channel. I hope it brought you value, and we will see you on the next one.